What's up, everybody? It's another episode of SLTV. You're here with Lucci, and our boy Bryan Wiener is back in the building at the Sang Lucci offices out in New York. Bryan, what's going on, man?
Hey,
What's going on,
what's up, buddy? It's warm out.
dude?
The
It's
birds
still
are
kind of it's still kind of chilly in Boston here, man. Boston, it gets no love, bro.
no, you're in the Arctic. Sorry about that.
We get no love there, and we get no love for the Patriots, man.
Oh,
Have you been seeing? Have you been watching? Have you been reading some of these articles, man? Like they are really going to town.
what happened?
Market Watch posted this article bashing the leadership, obviously Bob Kraft,
Oh,
and
dude, like, oh my God. It's like, you know what? I don't know. Bob Kraft is like, all right, you know what? Fine, I'll take the punishment. The first round draft pick.
the
And
first round draft pick.
he didn't even protest. Like, he hugged it out with Goodell. He hugged it out.
Hugged it out with him, man. Hugged it out.
Oh, it's all good. And then people still bashing him. So, you know what? Whatever.
So
hate us.
we have a bunch of things to talk about today. We're going to talk options vol. We're going to talk a little bit about the new coaching session, that we're kicking off here on sanglucci.com. But one last thing on the Patriots, man. Do you think Kraft should have caved, paid the $1 million, and just be done with it? And I honestly, after looking at it, reading it, and all this kind of stuff, I'm like, I'm glad it's just done. I'm glad he's just gonna pay it, and that's it. Suck it up, take the fine, take the brunt of the bad, obviously the bad connotation and all that kind of stuff. But at least they're not gonna go after. I mean, I hope at least they're not gonna go after anybody. You know what I mean? After this is said and done, I don't know. What do you think, man?
I can't handle the first round draft pick at all. I can't get over it. I hate it so much because Kraft and Belichick didn't do anything, and they're trying to say that, okay, well, because of Spygate, so we're going to add on top of it with that's where the fourth round draft pick came from.
Right.
That even seemed arbitrary because of the year after. So it would have been like a fourth round this year, and then the year. I mean, I don't care about the $1 million. Obviously, I don't know the pick, and they don't care about it either. But that draft pick. I don't care about Brady as much because Garoppolo's good.
Garoppolo's good, man. Garoppolo is good. Yeah. I'm not that worried about it. And dude, our season is not that bad. Our season is already not that bad,
That's all right.
So anyways, guys, we're going to get into it here with Bryan. As you guys know, or if you don't here, Bryan is an option specialist. Worked a lot with Heim at his old quant sort of fund here called Trading Machines. Also worked on the floor in Chicago here as an options market maker. So Bryan, we wanted to talk a little bit about, obviously we have some one-on-one coaching going on with you. For anybody who wants, some sort of in-depth, detailed approach here to trading options and possibly refining their strategies. But before we go into that, let's talk a little bit about, your particular niche of sort of trading. I know you sell a lot of vol out there. You watch the volatility curves and things like that. Can you give everybody a sort of, quick sort of fly description about your go-to trade? What is your go-to thing, and what is it that you're working on?
Right. So, a lot of times I'm trading Fridays, and I'm trying to, sell some decay, sell wings. So what I'll do, I will sell maybe like the 30 delta call, put, strangle, and then buy some protection against it. Maybe buy 2 versus 1, put on a ratio trade.
So for anybody who doesn't understand deltas and stuff like that, how far the deltas go out. I mean, can you give us like a quick example? Like say it was a name like this Baidu that is trading at 195. 30 deltas would be how far out of the money?
Right. It depends on the day. Right. So at the money is the 50 delta, and that's at 195. And I watch Baidu every Friday, and that sucks so bad sometimes. good thing to sell. But it might just all of a sudden flip and go up $2.50.
Yes.
We're trading at 195. On a Wednesday, I would say the 200 call is a 30 delta call.
Okay.
So it's like a 30% chance that it settles in the money.
Right.
That's based on the volatility. There's a lot of components.
Right. I would think that's a little skewed as well. 30% chance here for a Baidu, and it really depends on environment as well too. I'm assuming. We have a pretty low vol type of environment. Yeah. So for Baidu to move 5 points on a Friday, is pretty, that's a pretty tall ask, basically.
Right, but today it might be a 30 delta because it's a $200 name.
Right.
Because it still has a base volatility of, it's probably like a 36 vol, something like that. So then those calls are going to be around a 35 vol.
Right.
We're not going to get into volatility curves, but
sure.
So one thing would be selling that strangle. Another thing would be, if you can do it, would be selling. If you think we're going up, you think there's a better chance that we go up than go down, but you still want to sell some vol. You might want to sell the 200 calls and hedge them.
Okay.
And that's, you're doing that with the strangle as well by you selling a 30 delta call and 30 delta put. But if we start moving, then that 30 delta put becomes a 20, and that 30 delta call becomes a 40, and it gets paid from you. So one thing to do is to sell like the 192.5 put.
Okay.
As we're going up, so because you wanna make money on the volatility coming off on those calls.
Right.
As we go up, the volatility is going to come down. And as we go up, your hedge is going to make money. So what you want to do is, if we're slowly moving towards in a direction towards a call, an upside call, you're going to want to your hedge is going to be making a lot of the money.
Right.
So you want to be selling into a strike as we're going up to the 200 call.
Right.
You want to be short going into that, unless we're flying quickly through it. Then that hedge isn't going to be effective. The volatility comes up because people start buying those calls because they think they're going to fly through, or market makers don't want to be short anymore. They need gamma.
Right.
They're not effectively delta hedging.
So there's a lot of adjustments here that need to be made if you get a sort of a delta move in the stock. If you get a quick sort of delta move in the stock, can we get a couple of stories about me and you at the loft, and you were trying to hedge some of my wild ass positions? I remember this one time where I think I was long maybe 100,000 worth of calls, or maybe it was puts or something. I think it was Google. I think it was Google. And can you talk about how difficult it is to hedge somebody's strategy that, let's say, is as kind of risky as mine? I mean, how difficult was it for you to hedge some of the positions that I would create, or even follow some of the things that I was doing? Was it, give us an example, and then go deeper in a little bit about, how difficult it was.
Well, once you turn to me and you're like, all right, we're not going anywhere. I want to hedge the decay during the day.
Right.
During the day, because we'll talk about what happened the next day. After.
Right.
What I'll do is I'll see what you have. I won't even do the delta count. If I had time, I'll sit and do an Excel sheet and figure out the exact amount of options. And I did do that for a little bit.
Right.
When we stop moving and you turn to me, you're like, all right, that's it. There's not a lot of time because you're talking about Google's still in nickels. So you have to actually go and slam some other strikes. Your calls, you're going to have to sell other calls. If we're going down, you have to buy some puts. So what I would kind of do is do a risk reversal. I'd buy call. I would sell call, buy put, the delta hedge. But I would also lean towards selling more things to hedge the decay, because it's not just hedging direction.
Right.
You're also hedging decay.
Right, because oftentimes I would play the weeklies. We would be in a weekly, and therefore, it might be a Wednesday, or it might even be a freaking Thursday. So not only did we need to hedge on the, the directional, aka buying the puts, but we also needed to sell for the, the theta that would just sit there and burn on some of the options that I held, and I had sizable positions. Another issue, and Bryan, we'll talk about this in a second, and to everybody out there, was that, oftentimes that I would be sitting with a sizable position in one of these weeklies with no liquidity to be able to get out. You know what I mean? And that was also a big issue too, because if I started hitting the bid, with some of these illiquid options here, I was going to crush this thing myself. So I always had this little fear, that I couldn't just smack a bid for 500 contracts. So I would go ahead and turn to Bryan and be like, yeah, we need some directional hedge here or whatever. So it got pretty volatile there. It got pretty tense here between you and I. Can you give us an example of where you know, the hedge worked out well, and then the hedge just didn't work out too well.
I have two things. When it worked out well, we'll talk about that. So the next day in Google, because you held the shit overnight.
Yep.
We ripped off the hedge from the end of the day. You wanted to be naked, and we're like, all right, that's what we're doing. Next thing we came in, I think maybe Google was down a couple points, and you're like, we got to get out of this shit because we had bad decay. And so I think maybe you had like a 495 strike. I forget where Google was.
Yeah.
What I was doing was I just started slamming the next strike up because there's less open interest in the 2.5 strikes or the 7.5 strikes.
There's a lot less, and for everybody out there, you know, oftentimes you'll have an issue. You'll have a stock here with options that used to be $5 increments, right, or even $10. We used to have $10 on Priceline, and that was it. Now you got the $5 strikes, and you have the 2.5 strikes. So most of the volume is concentrated on, you know, the $5 strikes, the $10 strikes, or the dollar strikes. The half strikes are usually very illiquid.
And those are just, you know, when a quant developer, they're making a vol curve, those are just smooth points from the major, you know, they're not taking specific strikes and saying we're using the 495 strike for Google or the 545 strike, but they're using a certain amount of points. Most of the actual implied volatilities, how the options get their price, is from a smooth curve. Well, anyway, usually like the 2.5 or the 7.5 strikes don't have a lot of open interest.
Right.
And if you kept buying options, those market makers are short them.
Right.
So they might still be leaning. If we start coming down, they might actually fade, thinking that you might come in and try to sell it back to them.
Right.
So they're going to be fading their market, but they're not fading that other strike because there's no I guess an offset.
Right.
They have an offset in that one strike because there's so much open interest, and they want to fade someone like you that's going to come in slamming them, but they don't have an offset in that other strike. So I came in and started slamming the other strikes.
Right.
And then you accumulate, you know, if you're long 500, I was short like 800 of other strikes.
Yeah, I remember. I remember looking at the book. I remember looking at the book that day and be like, what the fuck is going on here, Brian?
We stopped the loss was like, it was like negative 5,000 instead of like 50,000.
Right.
Pete was all pumped about it, but it was just like so much fun. You just turned to me, you're like, do it. I'm like, just slamming shit. I'm like, fuck it. And I'm slamming like stuff that's meaty and the volatility is a little higher, like dollar options, $2 options, you know, and all of a sudden your options start pumping up in value because those market makers, you know, there's not enough of the order flow for them to get their gamma back, and we start moving because I'm selling calls, so stock starts dumping as a repercussion,
right?
Because everyone's selling stock against it. So that was good, and we came out alive. That was great.
I think you know, those were one of the situations where if I turned to you and was like, "Yo, go ahead and do it," like you didn't have any fear at that point, you know.
I love doing it for you.
I think the difficult part, especially in the beginning, was like, you know, the sheer I guess weight of having to hedge, you know, a huge directional position that you know, that is in a weekly or even 2 weeks out. I think it's a pretty daunting task for anybody.
And
you know,
freeze up. You're like, fuck, am I really gonna go and just smush this position now?
Right. I always had the issue of like when I need to sell and I'm looking at my name and I'm like, dude, this tape doesn't look that good anymore. You know, I got to start bailing. If I hesitate for, you know, maybe 5 minutes or 10 minutes or whatever, that's it. My price is gone. My price is gone. So at that point, it's like, it's do or die. We either hedge or I just book the loss. And if I don't book the loss, it turns into something ugly, which Brian is going to tell you a nice story about on that side as well.
Well, we had this Priceline little fiasco once, and you were short.
I was short and ass. I used to do this all the time, Thursdays and Fridays. But the problem was that I would short too close. I would short deltas that were way too close to the money. You know what I mean? And I'd sit there and I'd float with them. And then once these things were about to make this directional, you know, I needed to go ahead and just bail right away. Unfortunately, I was looking for the hedge and to stay in these positions by the end of the day, you know, towards the end of the day. So oftentimes we would get stuck with an option that just ripped on us.
And so we put the hedge on way too late, and And basically, I had you, and I was like I was trading my own shit, and I look over, and then stupid me, not looking at what was the close yesterday.
Right.
And we basically hedged all the way down to the fucking close, and price line, just as close, and price line just popped right back up.
Pipe right back up. And that's one of the things. Yeah, and that's one of the things where a hedge can go wrong.
If look at some technical shits.
Right. If a hedge can go really wrong, if it's done at the wrong place. If you start hedging at the wrong place, then it becomes two bad positions that you're even trying to work out of with adding new positions, and then it just gets to become quite the clusterfuck. So Brian, I guess for everybody out there that let's say has found themselves in certain situations similar to the ones that we just spoke of, what's the right thing to do? I mean, is it automatically put on the hedge immediately when you get into position? Is it having somebody there that's dedicated to making sure that, hey, if this position goes awry here, I'm going to go ahead and take care of it? What do you feel like is the best solution here? I mean, you worked at Trading Machines, obviously, with Heim. What would you say the best practices are for hedging directional options traders, aka most of the guys here that subscribe to our services?
Right. I mean, okay, so we're going just directional, and if you're directional,
right. And most people are just directional. You got retail accounts, 5,000, 10,000, 25 Gs. Most people are just long calls, long puts. What would you say here? Best practices here for people like that.
If you have a directional, it's because you're watching the tape, or you have technicals, whatever the case may be, and then like you're saying, like once it disappears, you need to put the hedge on.
Right.
Maybe, make sure, because you don't want to keep scalping yourself, putting the hedge on, taking it off, putting the hedge on, taking it off.
You don't want to do that, because then you rack up commissions. You end up getting, your mind gets a little messed up too, and now you don't even know what bias, you're trying to go for here.
Right. So the best thing to do is to hedge it up. It's not like the ball's going to come off and bleed right away unless it's a Friday, or that's decay, but it's not like if your long puts at the end of a big down move, you finally got in, and now we're plateauing. Well, one thing that you did wrong was that you bought too late for the direction, but then you bought a high volatility. So in that situation, you probably, if you think the tape is reversing, possibly, getting in too late, you probably just want to get out. I mean, you'd rather get out for a $300 loss. Right. A $3 loss.
Right. And again, just to reiterate here, I mean, the best hedge for most of you guys is to get the fuck out. That is the best hedge for most of you guys. Now, if you guys are in longer dated positions, you want to sit there and hold a little bit, maybe add a little income and stuff like that. This is where you can get really advanced as far as your options trading goes. And Brian here is the guy to do it. So what else you got there?
Well, right. So if you have a longer term thing, you're thinking, maybe a rotation in that name, or a couple of names. So your long puts, as you see it breaking some moving average, or like, now I'm going to get in. You have some signal why you're going to get in for a couple of weeks. Yeah, a good thing to do is if you're a technical guy or you're a tape reader on top of that, if you see a buyer coming in, buy some calls and get like $1 move in that name.
Right.
Make like $500.
Right.
While you're hedging that, so it brings your total cost down.
Right.
So if you see a reason why it's going to start going against you, but you want to hold it, start buy a 10 lot of calls, whatever you want to do.
Right.
I would suggest a more a meatier option with a higher delta, 50 delta, near at the money. If you go like 80 delta call, you have a wide gap, and some of you guys need to know that if the spread's very wide, you shouldn't just buy the offer or sell the bid. So
yeah, another great concept here. And again, the retail gets screwed by this quite often. I mean, even if they see a directional coming, they'll be in listed options where, you're talking 40, 50 cent spreads. And, most of them are sitting there buying the offer and not understanding why, in most cases, or in many cases, whether you're hedging or whatever it is, that's a shitty move. It's like a shitty chess move, man. It's a shitty chess move.
Well, let me tell you why. Well, first of all, if it's 40 cents wide and you cross the market, you're giving up 20 cents. So what are you doing? If it's a 40 delta call, maybe you don't even look at the delta. You're giving up basically a 50-cent move.
Yes.
You have to have a 50-cent move just to be buying from the bid.
Yes.
And also if we're reversing if we dump down and you want to start buying a dip, going back up, the vol came up on the way down, and there are market makers want to sell you calls if we start reversing back up. They want to be short calls, like I was saying, short calls, long stock. So they'll sell. You could probably bid like a third higher. Like if the spread is 30 cents wide, you could probably bid 10 cents above the bid. Right. You might get hit on some shit.
And get a fill. Absolutely.
Yeah.
Absolutely.
Especially on like an Amex, or if you can say Amex, SIBO, ISC, the non-maker-taker exchanges, you have an even better chance. Most of you guys probably, it's like Scott Trade, and you get filled on whatever. But
right, most of them do the auto execution and things like that. I mean, what Bryan is talking about is that certain exchanges, you can get, you don't have to deal with a maker-taker situation, in the sense that, let's say you take liquidity with SIBO, you don't have to pay, you don't have to pay a taker fee.
Like 30.
Right. So there's incentives for market makers to hit certain exchanges, and that's why you want to route through those. And again, like, this is all advanced stuff where, Bryan is very, very knowledgeable about all of these different sort of intricate places here in the option space when you're trading a good amount of volume here, selling spreads. Even if your strategies get a little bit more complicated as far as, risk reversals and things like that. I mean, Bryan is your freaking guy. So let's move towards, the topic of the day here is the mentorship. I mean, this is something that, a lot of people do want. They want that one-on-one sort of approach. I mean, I used to do it. Way back when I was starting things out. And again, I kind of grew to a place where, I wanted to trade. I wanted to, deal with, growing other parts of the business and things like that. So I had to kind of lean away from it. But we're happy to offer mentorship now through Bryan here and through a couple other folks. I'm going to go ahead and pop the link here on Twitter. But Bryan, why don't you go ahead and give us a little spiel? What can they expect when they sign up for mentorship with you?
Right. I mean, you're basically getting what I've been talking about. I'm not trying to, go outside of anyone's, abilities.
Right.
Basically, I'm going to see what what do you need to know? I mean, I've traded on the floor up through electronic, black box, gray box, and with my finger. I market make dapple for 2 years.
Right.
With my finger. I mean, listen, we're not trying to reinvent the wheel, but we got to make sure that the wheel fits you. You know what I'm saying? We're not trying to put 22s on a fucking Aries K car from 1985. So, it's
on the old Honda Civic hatchback.
Well, actually, that's okay. But yeah, so Vault, I mean, what do what kind of level trader are you? Do you just simply want to do direction, execution, hedging your direction is important. If you want to go from direction to volatility, maybe selling stuff for the summer.
Right.
Obviously I can teach you about that. It just depends on the type of trader, I mean, right. Not to float my boat, but what don't I know about trading? I've been doing it for 15 years. So
right, absolutely. And for the options guys, I mean, we have a lot of active options traders out there that are looking to advance their strategies a little bit, possibly add some some hedging strategies in there as well, possibly go into selling vol for the summer. And that's actually another topic that we wanted to hit on as we go into the summer months, and as we get a little bit more choppier and choppier here on the indexes. I know you guys have noticed today here we had the FOMC, yelling, what did we say, maybe not June rate hike, and then all of a sudden we rallied, 10 handles on the news, and then we retraced the whole damn 10 handles. So even though we're in all-time high territory here, it's not like you can just grab a call and make some freaking money. These rotations hit hard and they go quick. So, there's a lot to be said about the fade trade or selling a lot of these sort of volatility spikes. So Bryan is sort of an expert in this sort of area. So what can you add as far as going into the summer months? We get all that low volatility. How would you go about building a sort of a sell vol strategy, let's say, for the summer? Right.
So as the vol is kind of coming off, the closer to expiration, the weeklies, the 1-2 weeklies, the volatility is going to be, I think your angle is going to be much lower. Right. So you might want to probably sell like 3-4 weeks out. You might be able to sell like in a Netflix, I don't know, a $50 wide strangle for like $3, a 10 lot, you know? And yep. What's the chances Netflix moves $50 if we're just chopping around? You might want to hedge it a little bit if it looks like we're going, or take some of it off. But, you know, the vol is going to get pretty low, and it's going to be specifically with the weeklies. And I mean, you're not going to sell you're not going to sell a Netflix I use Netflix because that's my main thing on Fridays. But you're not going to sell a straddle and a $600 name at like $4 on a Monday, or probably on a Wednesday or Thursday. But supposedly it's so cheap that it's too cheap to sell it, and it's also it's too warm to buy it. You know, so you really need to actually do directionals. Actually, it becomes cheap for you to actually put a directional position on, do some call spread, buy a cheap call spread or put spread. You know, if we're topping up, I would do a credit spread. You know, buy a credit spread. So you have some good upside. It depends on how cheap. If you buy a $2.50 put spread for 50 cents, and there's a good chance it'll be dumped down, Netflix could move like 3%, 2%. Right. What's that? That's, you know, $12 to $18. It could do that. Yep. So, you know, you're kind of quadrupling your money, you know, and there's a good chance, you know, if we're topping out. I saw a big seller in Netflix yesterday. You know, I mean, if we hit 628 again, 625, and you see them stepping it down, you might want to buy a put spread. Right. Because that fade trade
on Netflix will usually last, you know, a good 5-6 points, possibly even more than that. Absolutely. And then a lot of the fade trades too that we've been seeing, you know, we'll see a ridiculous spike up in a lot of, you know, like when they rotated to Apple and Facebook. You remember Facebook that day? I believe it was last week. Gapped up to like 78.5. And then ran to 81.5, almost hit 82. And then literally for the next 4 days, all the volatility came off on every single call, whether it was a weekly, next week, month, or whatever, man. I mean, the same thing happened in Apple. And you look at the big spike up today in Baba and for GoPro, I'm assuming the similar situations start happening. So when you see these aggressive moves here, you know, these big 4 or 5% moves, in this market environment that we're in, generally speaking, most of these things just fade off. You know, they spend the next couple of days just kind of doing nothing. And if you can sell some good premium up there on those calls or puts, vice versa, it can get pretty good. And you can just kind of be patient about it, you know. Especially like the next morning after a rip on, you know, into the close, it spikes up and it comes back down. You know what I'm saying? It might move up another $2 and then it comes off. So that you want to sell it right in the open and kind of just like have an idea. The call closed at $2 and we ripped up another $1.50. I don't know what's the delta, and I'll sell it. I'll try to offer it at $3.25 or something like that. Have some number in your head. What's cool? Right. You know, throw it on the open. Someone might buy it for me. Indeed. All right, guys. So we're going to close it out here. Again, we are now doing one-on-one mentoring here with our boy Bryan Wiener, who is our option specialist. We also have Dan Shep, who runs the show over at Access a Trader. He does mostly equities and a lot of I believe it's he uses pivot points and a lot of other technicals and things like that. So we also have mentoring from his side. We're also going to bring in some other mentors as well. I might even step into the mix. So for whatever strategy that you guys might be employing out there or want to get into, you know, we have the right person for you. I'll tell you right now, for options trading, you know, for advancing your sort of options career, Bryan is the dude that you want to talk to. So hit us up, Lucci at sanglucci.com, and we will get you in touch with Bryan. And, you know, you can talk to him for a consultation just so he can tell you a little bit about, you know, some of the things that he's going to do for you. All right. So, Bryan, dude, yeah, what do you got? I know Action Jackson wanted me to talk about 9/11. Oh, no, we're going to save that, man. We're going to save that for September 11th. We'll do it the next time. We'll talk. I just let him know because I knew he was all psyched up about it. Guys, we get a lot of Twitter followers that are pretty passionate about, some of the guys that come on SLTV and everything. And one of our subscribers would love Bryan to tell a story about trading after 2011. And I think, when we get to September here, I'm going to pull him on, and we'll go through all those stories as well. I'll go through mine, and we'll kind of have a whole reminiscent experience here. So, Bryan, dude, thank you for joining, man, and we will see you soon, brother.
Later, yo.